Kaan, Cengiz here from Northeast Wealth, recording this video for all of our members as a bit of a market and economic update. Before we get into it, please take a moment here to pause and read the general advice disclaimer. Just reiterating that this is a general presentation only. Nothing here is tailored to anyone, nor is it meant to be inferred as personal advice. If you feel you need to action anything on the back of this presentation, please don't hesitate to reach out to your advisor. What are we going to discuss today? So I'll start with some hot topics in the global conflicts and what's happening there. I'll move on to the VIX and why I feel that's a great indicator to refer to judge what's happening. We'll discuss the local market, a couple of points on what you can do yourselves, and then we'll finish with a couple of notes on our own portfolios. So, global conflicts, starting with our friend in America, Donald Trump, and his tariffs. So, as we can see on the far left-hand side of this chart, which is actually the VIX, Liberation Day, as it's known, when Trump announced his tariffs, saw a huge spike in the volatility index, which naturally markets reacted negatively to. A few days after that, we had the pause, and things have been steady since. Jumping to the far right-hand side, we see the jumps from the Israel-Iran conflict, which I feel also puts things into context from an economic point of view in terms of how markets have adjusted and absorbed this news. Judging by what we're seeing here on the VIX, wars are almost negligible for markets. We seem to be numb to what comes out of that, but I'll explain further what the VIX is in a moment. To provide context into what's happened over the longer term, this slide here is a 5-year window. So we can see, starting on the right-hand side, the small asterisk at the very bottom is that Israel-Iran conflict, as I mentioned. Next to that, we have the tariffs, and then on the far left-hand side, we have COVID, which really puts the current circumstance into context in terms of the news may report that we have these wars, which from a humanitarian perspective is awful. From a market perspective, it's relatively normal. What I mean by that is that's what the VIX is telling us. So looking onto these next couple of slides, a score between 10 and 25 in the VIX is known to be normal or stable. That's where we like to be. We're currently sitting at 16. So judging by that, where we are is to be expected. And if we look over the last 9-10 years, it's where we've spent most of our time. Moving up to 40 is when we get into fear, noting that there are only a handful of scenarios that edge into this fear section. This is where you see some drops in market, some 2-day corrections. The real big swings come beyond that. So anything above 40 is when the VIX determines there to be panic and markets really tank, which is emphasized here by 1, tariffs, but then 2, COVID. I think we all know what happened to markets during those 2 periods. And that's why I like to use the VIX as a bit of an indicator as to what's happening. A bit of a pulse check in terms of, yes, we have these wars, which, as I said, we can't ignore how awful they are. From an economic standpoint, it's actually okay, and markets seem to be adjusting quite reasonably. Now, given the conflicts, the recent conflicts are in the Middle East, oil is naturally on the tip of everyone's tongue. At the beginning of Israel's bombing of Iran, we saw a spike, as was to be expected, and then Donald Trump announced the ceasefire, that he had eased the conflicts there, and things dropped almost immediately back to levels where they were pre-conflict. Naturally, it'd be remiss of me to not include some of Donald Trump's finest tweets here. When he realized that prices weren't coming down, he thought he'd tweet and give everyone a couple of warnings. And then he just topped it with the cream on top in terms of drill, baby, drill. I think I'll leave that there. Closer to home, ASX 200 is doing what the ASX does. We had a dip during the tariffs. Thankfully, we've recovered since then, which again emphasizes that point of staying invested in the market. A common term you might hear from your advisor is time in the market rather than timing the market, and this is a key example here. How does this reflect to what the S&P 500 is doing? We're on par. I'm sure advisors have mentioned before that we follow the US market quite closely, so when there's bad news there, there's generally bad news here and vice versa. Inflation, a hot topic on everyone's minds over the last few years, is back under control, thankfully. That's been the narrative for a little while now. We're in a great range, which has seen the RBA cut rates, which we've got here. 2 recent rate cuts, currently sitting at 3.85%. Now, I've noted here, what's important is that we all stay on top of our mortgage rates. There's no guarantees that our banks will reduce those rates. They're there to make a profit, and so they will delay that as long as possible, and if anything, not reduce to where they should. So it's important to get on the phone and make sure you're on the front foot there. What's the currencies doing? The euro and the pound have performed poorly, both down about 10%. US is on parity to where we were this time 12 months ago. What does this mean? Anyone hoping to escape to Europe is going to pay higher prices, purely from an exchange perspective, and that equates to roughly 10% both for euro and the pound. Controlling the controllables. So this slide is what can you do? There's a lot of noise out there starting on the right hand side. Ignore the noise. The VIX is normal, the media is suggesting panic, and to always remind yourself that your investments are aligned to you. They're tailored to you based on your risk profile, your preferences, and your goals. Hopefully your advisors made it very clear from the beginning that markets go up and down, and so it's what to expect. The things in your control, well, how's your spending? Are we aligned there with our goals? Are your utilities the best rate you're going to get? As I mentioned, your interest rates, are they sharp? Are we saving as we should be, as has been discussed? And what about our budget? Is that on track? These are the things you can do, and these are the things that will ultimately have the greatest control and then confidence in your approach moving forward. Our portfolio, as we can see here, has done quite well. So this is going back to 2018 when we started, and there was a spike early on with a bit of outperformance in that 2021-2022 period. Since then we've been on par with the benchmark, still sitting slightly ahead, and as it states at the bottom of this slide, we're up about 90% over that time. This is our high growth portfolio, so it would be depending on your risk profile and where you sit in this, the returns will differ. In terms of what's coming, we've got portfolio updates coming in the new year, so stay in tune for that. Otherwise, that's today's quick presentation. As I mentioned early on, if you have any questions, please feel free to get in touch to your advisor or call the office. We're always here to help, and wishing everyone a wonderful day.